Good morning, traders and investors. Elf Beauty just reported and delivered 27th straight quarter of growth, but while revenue rose 14%, margins are under pressure and debt is rising. So what does this mean to us retail investors? Well, we're going to break all of this down together. Ladies and gentlemen, welcome to Wealth Down with me, Norbert Menhardt, where I build and protect wealth. So let's get started with Elf Beauty. First of all, a couple of words about the company. About that. For those of you who don't know, Elf Beauty is a mass market. So let's go over here. Mass market beauty and brand focus on cleaning, vegan, cruelty-free products and accessibilities, of course. The company sells under brands such as Elf Cosmetics, Elf Skin, Peace Soul Care, Well People, Natural Nutris, and Road, targeting both the US and the international retail and e-commerce channels. So for traders, this is a consumer growth story, but one influenced by tariffs. But how hard? We're going to take a look at that. And cost pressure and retail channel dynamics. Now, this is a lower cost company than other brands, and there's where this is going to get interesting in the upcoming years. So let's first of all go over the earnings. We have here our quarter two results for 2025, and also we have an outlook for 2026. So net sales increased 343 million, up 14% from 301 million. Gross margins declined 165 bips, and that is 69%. A GAAP net income 3.0 million or $0.05 a share EPS. Now, adjusted and net income 440 billion, sorry, that's million, so with an M, or a $0.6 adjusted diluted EPS. Adjusted EBITDA 66 million, roughly 19%. Net sales down 4% year over year. Balance sheet liquidity cash 194 million. Long-term debt 831 million. So fiscal outlook 2026, net sales expected to increase 18 to 20% to 1.5 to 1.57 billions, that is, versus 1.31 billion per year. Now, the stock did not have that good of a reaction. And to take a look here, after hours, boom, from $118 a share, a dip to the lows of at one point they were at $82 a share, and then came back a bit, gave also back a bit to $92 a share. So the stock market did not like their results. It was most likely because of the debt story. Now, let's take a look at the company itself. So a couple of statistics here. A strong growth in revenue, but margins constrained and heavy debt load may damper market enthusiasm. As you can see here, it just boom went down. So while sales are rising, which is a positive, the risk profile for traders increased, eventually meaning, also if you take a look here at overview, just some forecasts for this company, we'll say that it is currently at a strong buy, but just after this dip came in, we're going to see these numbers changing. So a average year-to-year forecast for this stock would be 28%. Now, I'm always going with somewhere between the average and the minimum forecast. For my part, I almost take down 20% for something like this, because high debt plus cost pressure equals less margin for error. Okay, so if something goes wrong, then this is going to come down at least 20%. Now, let's take a look at the commentary of the CEO, which is Tarang Amin, that results, and I quote, are a continuation of consistent category leading growth were delivered over the past 27 quarters, and end quote, and pointed to the market shares gains and the record, and I quote again, record-breaking launch of Road in Sephora, North America. So let me just translate the entire thing for you. Management is confident about the expansion and channel growth, but emphasizes on share gains, suggests competition remains intense, and cost/sales pressure is still in the market. Now let's take a look at a couple of diagrams here, and also what's the take on the trader side of this. So fundamental view, post durable revenue growth, brand strength, plus omni-channel footprint. That is a positive. A negative, so cons, will be gross margin expansion, rising SG&A, because they rose it to 67% for net sales. So that is not very good. Heavy long-term debt. And I do not like debt, excepting when it's invested extremely well. And also in this environment, I don't know, that is not my friend. We are still living in a high margin environment, or high-ish. There was also higher margins, or higher rates, not margins. So technicals. Assuming ELF has rallied on growth, but may face resistance to margin leverage and concerns, key support could be somewhere down here at 100-ish. After this just break through the 100, so the 200-day moving average. The red line here is the 200-day moving average. We can, as we saw in the aftermarket, because we don't have the numbers here in this chart for the aftermarket, we can see that in the aftermarket it closed under 92, so went to $82 a share, but closed at 92 or somewhere there. So let's see how this stock opens. Currently, no more support underneath the stock, so it just boom went down here. The next line of resistance would be this area, so somewhere between 73 and 50, I would say, which is intense. So if the stock comes down here, you can see, okay, they had to have a little bit of that, a lot of that, but it could be that this would be a great buying opportunity. Now, selling some puts down here is a probability or possibility with a high-ish probability of not being assigned. So if you want to play it this way, or if you want to sell it, and with the risks, you have the money, you want to say, hey, I would like to either not be assigned at $70 or $60 a share of ELF beauty shares, and if not, then hey, I got a little bit of cash there. Let's see on the options chain where this would trace at the 70. You would get, come on, load. Currently you would get nothing. Let me just open my Tasty accounts. Let's see on the 16th, and at 70 you get nothing. Let's go for the 44 days out. So with expiration date December the 19th, you would get for 70 also nothing. For 80 you would get currently, but these numbers are before the closing bell. So let's just wait when the market opens. Let's see how this looks, because at 70 you should get some really good numbers now. So let's do a little bit of takeaway here for by the way, if you don't know for what ELF stands for, is eyes, E, L, lips, and F, face. That's ELF, eyes, lips, and face. Okay, so the bottom line of ELF Beauty is it's growing. It's really growing here. Beauty is growing 40% Q2 and expecting 18 to 20% for the next year. Both growth alone isn't everything. For retail sales, you want to see growth, margin expansion, and manageable debt. Debt is a little bit too high. So if it doesn't work out for them, if there's a crisis, then there are a lot of trouble, these guys. For retail sales, you just need to keep an eye on that. So high debt is not good. If you believe brand momentum and products launches, because they did grow from 2021, 13% in the US, and to 45% 2025. In Canada, they grow from 8% 2021 to 26% 2025, and also UK from 6% 2021 to 90% in 2025. So what to watch for next? Margins in upcoming quarters, of course, if they will grow or if margin will improve. Debt management, reducing a long-term debt in improve interest coverage. Product launches, because that's what they sell. If they launch new products, then everything depends on their products. If they have good products and launch new exciting products, then the market will add more and more value to them. How big will Rode become in Sephora and international also, and technical triggers like high volume breakouts or clean pullbacks to support. Now, because there are less pullbacks, so this pullback is definitely at $92. There's literally no more support here. Let's also take a look at the weeklies. This was the daily chart. On the weekly chart, because you could see some support also in the Ichimoku cloud. See, they're in the cloud. It's also the day. No, this is the weeklies. They're in the cloud. They're in the red zone. If they manage to break out of here, then I could see potential for this. So currently, for long term, I may consider adding some shares, but I would rather play the put game. If I'm assigned, then I have some shares at a really good price. If not, then I'm going to have some cash and generate some income. Okay, so if you want further weekly breakdowns like this, where we dig into numbers that matter because we need good information in order to make good trades or invest for a long time. That's what I do here. Wealth Dom. I build and protect wealth, also my health. That's it. I'm Norbert Menhardt, and stay safe out there. Catch you next time. Bye bye. Like and subscribe.